Welcome back to the deep dive. This is where we take that really dense source material, the strategic reports, the deep research, and we try to distill it down into something you can actually use.
Exactly. We're giving you the shortcut to understanding the complex blueprint behind some of these major industry players.
And today, we have a really fascinating one. A company called Bio-Techne Corporation.
Right. Now, that name might not ring a bell for everyone outside of, say, the science community, but their products, their high-tech instruments, they are absolutely foundational to modern life sciences.
Foundational is the right word. I mean, biotechnology development, advanced clinical diagnostics all over the world.
They are really the definition of an essential infrastructure provider.
That's right. And our mission today is, I think, pretty ambitious. We're moving way beyond a simple corporate biography.
We're not just reading off a list of products.
No, we want to extract the underlying strategy, the almost audacious plan that let this company, which trades as tech on Nasdaq, by the way, transform itself from a small regional supplier founded back in the 70s.
Into a massive global S&P 500 component.
Right.
I mean, we're talking well over $1 billion in annual revenue.
It's an incredible story. And the hook, the really surprising part, is how they did it.
It really is. Because when you look at their 2025 financial snapshot, US dollar, $1.22 billion in revenue, assets at $2.56 billion, over 3,100 employees globally, it just screams stability.
Right, market dominance.
Exactly. But then you rewind the clock, you look at the timeline from about 2013 onwards, and the surprise is the sheer volume, the velocity of the acquisitions.
It's relentless.
Completely. The highly targeted strategic acquisitions are what actually built this giant. It is, I would argue, the most aggressive growth by acquisition story in life sciences in the last decade.
It's a blueprint for buying market share and technology at the same time.
Huh?
So before we dive into that acquisition spree, let's just establish what Bio-Techne actually sells.
Good idea. So our sources say they develop, manufacture, and sell life science reagents.
So the consumables.
The consumables, right? Also instruments, the machines and services. But the key is they segment the market into three very specific areas.
And we need to keep this three-pronged focus in mind because it explains every purchase they made.
It does. So number one is the research market. Number two, the diagnostic market. And three, the bioprocessing market.
Okay, so research, diagnostic, bioprocessing.
Understanding those three segments is, well, it's the master key to their whole M&A strategy. The research market is your academic labs, early pharma, R&D. They need specialized, high-quality stuff.
In the diagnostic market.
That demands regulated, super reliable instruments and controls for clinical testing, things for disease monitoring, screening.
Okay, and bioprocessing is the big scale-up stuff.
That's it. The companies manufacturing things like monoclonal antibodies or gene therapies, they need bulk materials, certified, and really robust high-throughput instruments. Bio-Techne just systematically bought companies that served all three.
So they're not just selling test tubes.
Not at all. They're selling the foundational tools for every single stage of modern medicine.
Okay, let's unpack this history. You can't really get the pivot without knowing where they started from.
Right.
The genesis of this company goes all the way back to 1976, founded by a Roger C. Lucas in Minneapolis, Minnesota.
And that date, 1976, is important. It puts them right at the dawn of the modern biotech era. We're talking early genetic engineering, molecular biology.
And the original name is a huge clue, isn't it?
Oh, it's profoundly important. They were called Research and Diagnostic Systems, Inc.
So no ambiguity there.
None at all. It immediately defined their function.
Yeah.
Supplying materials for research and for clinical diagnostics. They carved out their niche really early, focusing on quality.
So they had that foundation from the start.
Yeah.
But the first big structural shift, the one that set them up for this aggressive growth later on, that came in 1985.
Almost a decade later, yeah.
That's when Research and Diagnostic Systems merged, and they became Techne Corporation.
And that 1985 merger was the pivotal structural moment. It wasn't just, a new name on the letterhead.
No, it was how they went public.
Exactly. It transitioned them into a public company listing on Nasdaq as tech. And this matters so much because becoming public established the financial architecture.
The ability to raise money.
The ability to raise money, access huge pools of funding, and critically, the ability to use company stock as currency for all those acquisitions that would come later.
Right. Without that 1985 IPO, the 2013 hypergrowth period just couldn't have happened.
It couldn't have been financed, not at that speed.
So now we fast forward almost 3 decades. We're at 2013, 2014, and this is where the real strategic pivot begins.
Driven by a leadership change.
Right. In March 2013, Charles, everyone calls him Chuck Cometh, was named the CEO and director of what was still called Techne Corporation.
And this change is the starting gun for the whole new era. When you bring in a new CEO with a mandate for growth, it signals something is about to happen.
And it happened fast. Cometh arrives in March 2013.
And the first major 9-figure acquisition happens that same year, just a few months later.
It's incredible timing. It feels like the strategy was already in place. But the formal announcement, the rebranding, came a bit later. February 2014.
Almost a year after the CEO.
That's when the name officially changed from this sort of generic Techne Corporation to the much more powerful, sector-specific Bio-Techne.
And what's so fascinating is that time gap. The sequencing of events tells you so much.
How so?
Well, you have the new CEO in March 2013, then the first massive strategic action, the acquisition of Bio-Gnostics for $104 million cash, happens just 4 months later in July.
A huge commitment right out of the gate.
A massive commitment to diagnostics. It signaled their new intent, and only after they demonstrated this new direction with aggressive action did they formalize the identity with the rebranding.
So the name change from Techne to Bio-Techne wasn't just some marketing exercise.
Not at all.
It was a public confirmation of a pivot that was already happening financially and operationally.
Precisely. It was a laser focus. Shedding any ambiguity, they aligned their name with the highest growth sectors: life sciences, biotech, technology integration. It was a message to the market, to investors, and to future acquisition targets.
A message that said, we are all in.
All in on biology and technology across research, diagnostics, and bioprocessing.
That name change really kicks off the core story we're here for. The transformation through M&A between 2013 and 2023. I mean, we are looking at a hyper-aggressive, decade-long growth period.
And it was driven almost entirely by these targeted acquisitions, not slow, organic growth.
The pace is just relentless.
It really is. And our sources list, well over a dozen key acquisitions in that period. Each one wasn't random. They all fit into a specific strategic bucket.
Like consolidating supply chain.
Right, or acquiring cutting-edge IP, or, and this is the big one, moving the company up the value chain from just a reagent supplier to a sophisticated instrument provider.
Let's start with that early focus on diagnostics. Right after Cometh took over, the Bio-Gnostics deal, $104 million, all cash, in July 2013. Why lead with such a huge bet on diagnostics?
Well, it was a strategic declaration. It was meant to reshape the company's revenue profile immediately. Diagnostics, especially things like quality control and calibration materials, which is what Bio-Gnostics did.
It's a more stable revenue stream.
Much more stable. It's less cyclical than selling reagents to academic labs where funding can go up and down. So dropping $104 million in cash on Bio-Gnostics showed they were serious about the regulated clinical market.
And they doubled down on that later.
They did. 2 years later, they acquired Clinica Corporation in June 2015, which also bolstered that diagnostics portfolio, again, focusing on quality control.
So they weren't just buying the tests themselves, they were buying the quality assurance systems that make those tests reliable.
Exactly. That creates a really high barrier to entry for competitors. They're positioning themselves as essential partners to clinical labs.
But while they were building up diagnostics, they didn't neglect their core research market.
No, they were simultaneously expanding their foundational toolkit reagents and antibodies. I mean, that's the absolute bread and butter of molecular biology labs everywhere.
And this is where that consolidation strategy really comes into play. They just identified key players and bought them out.
The perfect example is Novus Biologicals, July 2014, for $60 million. Novus was a respected brand, and buying them instantly bolstered Bio-Techne's entire reagent and antibody offering.
So it was a shortcut to a bigger catalog.
A massive shortcut. In the life science supply world, brand reputation and catalog depth are everything. Acquiring Novus gave them a huge slice of that multi-billion-dollar market overnight, without years of internal development.
And it wasn't just one big purchase. They kept going with smaller, more targeted acquisitions, like Trevigen in 2017 and Atlanta Biologicals in 2018.
And those smaller deals show how refined the strategy was. They were consolidating specialized supply chains to create a complete solution. Trevigen, for instance, specializes in DNA damage reagents, a high-value niche for cancer research.
And Atlanta Biologicals?
They specialize in the fundamentals, high-volume consumables, like cell culture media. So by acquiring them, Bio-Techne secures a fundamental supply line for the booming bioprocessing sector. It's a two-pronged attack.
Big platform buys for revenue growth and smaller reagent buys for supply chain control.
Exactly.
And we can't forget their global ambition. The acquisition of Shanghai Prime Gene Biotech Company in April 2014, that was a very specific geographic move.
Oh, highly targeted. It was about getting an immediate established foothold in the massive Chinese life science market. You have to be in Asia to be a global leader.
So it's a way to bypass all the usual red tape.
Instantly. It lets you integrate a local supply chain and distribution network. It shows their strategy wasn't just about what they bought, but where they could sell it.
So we've got these three streams of acquisition: diagnostics, core reagents, and geographic expansion. But we have to talk about the financial engineering here. Not all of these were simple cash deals.
And this is such a critical point. How do you manage risk when you're buying complex, high potential, but sometimes unproven technologies?
It's all in the contract structure, right?
It is. The genius is the difference between a simple cash purchase and using what are called earn-out payments tied to performance milestones.
And the best examples of this are Cyvec, Exosome Diagnostics, and Asuragen. These were not cheap.
Look at the numbers. With Cyvec in 2014, it was $60 million in cash up front, but then up to an additional $135 million in earnouts.
So a potential total of almost $200 million.
Right. And then Exosome Diagnostics in 2018 was even more dramatic. $250 million up front, plus a staggering potential of up to $325 million in milestone payments.
That's a potential total of $575 million.
And Asuragen in 2021, $215 million up front, plus up to another $105 million in milestones.
So much of the purchase price is tied to future success. Isn't that a much riskier way to do a deal compared to just buying a stable company like Novus?
It's actually the opposite of reckless. It's a fundamentally shrewd risk management strategy.
How so?
When a technology is promising, like Exosome's liquid biopsy platform, but its commercial success depends on, say, getting difficult regulatory approvals or hitting huge revenue targets, Bio-Techne is essentially hedging its bet.
So they're saying, we'll pay a fair price for what you are today, but the real premium is tied to what you become.
Precisely. The initial cash gets the deal done, but the massive earnout acts as an insurance policy for Bio-Techne. They avoid paying the full premium for just potential.
And at the same time, it keeps the original team invested.
Massively. It creates a huge incentive for the founders, the key scientists, to stick around and make sure those milestones are actually met. It aligns everyone's financial interests.
So if Exosome Diagnostics nails the FDA approval and launches a major test, the original owners get that huge payout if it stalls.
Bio-Techne still owns the IP, but they've avoided paying the full, highest-risk premium. It's brilliant.
And the fact they used this structure repeatedly for their most advanced acquisitions shows it was a core part of the strategy.
It shows their M&A strategy wasn't just about getting bigger. It was about intelligently managing the risk of buying companies on the scientific frontier.
Okay, now let's shift focus to those highest-priced acquisitions, because this is the phase where Bio-Techne really moves beyond being just a supplier of consumables.
And becomes a provider of instrument platforms and proprietary tech.
And that transition is absolutely key to understanding their jump into the S&P 500.
It's a crucial distinction. The market values companies that sell capital equipment and instruments much higher than those that just sell consumables.
Because the instruments create a locked-in ecosystem.
That's it. It's the razor and blade model. Once a lab spends $100,000 on a specific protein simple machine, that customer has to keep buying the specific reagents and kits from Bio-Techne to make it run.
And this is where it gets really interesting. The investment in instrumentation. The purchase of Protein Simple in August 2014 for $300 million.
A huge signal.
Is a massive strategic leap. $300 million in cash right after the new CEO and rebranding.
And Protein Simple brought them into high-end lab instruments and automated proteomics tools. Proteomics, the study of proteins, is the high-value application of genomics.
So they went from providing the ingredients for the experiment
To providing the entire high-performance automated kitchen. It was a clear move into high-margin capital equipment.
And then just 3 months later, the aggressive move for Cyvec. That was the deal with the huge earnout potential.
Right. And the size and structure of that deal implied they were buying another very specific high-potential platform technology.
Something that promised automation.
It absolutely does. Cyvec brought in a high-throughput platform for sensitive protein or biomarker analysis. It just showed their continued appetite for technologies that promised automation and standardization, things that are non-negotiable for big pharma and bioprocessing.
Okay, moving into the even more advanced stuff. Cell and molecular diagnostics. This is where we see the next game-changing investments. Advanced Cell Diagnostics, or ACD, in August 2016.
Another big one, $250 million up front, plus $75 million in possible milestones.
So what did ACD bring to the table?
ACD had proprietary technology for what's called in situ hybridization, specifically their RNAscope tech. A really powerful way to analyze genetic material like RNA directly inside cells or tissues while keeping the spatial context. Before this, you just grind up a tissue and lose all information about which cells were doing what.
So you could see exactly where genes are being expressed.
Exactly. This is invaluable for personalized medicine, for understanding tumors. It's moving beyond just quantifying stuff in machine to seeing where it is in a tissue sample.
So if Protein Simple gave them the tools to analyze bulk proteins, ACD gave them the sight to see DNA and RNA at a cellular level.
That's a great way to put it.
But the acquisition that just screamed high risk, high reward was Exosome Diagnostics in 2018. That massive potential price tag of $575 million. Why make such an enormous bet?
Well, this is where you have to understand the science. Exosomes are these tiny little vesicles, basically nanoparticles, that are released by almost all cells, including tumor cells.
And they carry information.
They carry molecular cargo that reflects the state of the cell they came from. Exosome Diagnostics was a pioneer in using this for liquid biopsies.
Diagnostics from a simple blood draw instead of surgery.
That's it. And liquid biopsies are one of the holy grails of oncology.
So the promise is detecting cancer earlier, monitoring recurrence, all non-invasively.
Absolutely. So Bio-Techne was buying a leading position in a potentially transformative technology. That huge price tag wasn't for current revenue. It was a massive strategic bet on capturing a huge chunk of the future diagnostics market. It was an investment in pure, future-facing IP.
It's amazing how they're balancing these proven research tools with these highly speculative, high-reward technologies, which brings us to the acquisitions that were clearly targeting future capabilities.
They're anticipating where the research funding is going to go next.
Like the purchase of Biogen Biotechnologies in June 2019.
A specific, timely focus on gene editing technology. You just can't be a major life science provider today without a deep involvement in gene editing and gene therapy. This was a strategic move to make sure they had the tools for that whole burgeoning field.
And then Asuragen Inc. in April 2021, another big milestone-driven deal.
Asuragen reinforces the clinical molecular side of their diagnostics market. It's about high-complexity, regulated molecular testing for things like inherited disorders. It keeps them at the high-margin end of the diagnostic spectrum.
And finally, to round out this decade of M&A, two extremely high-tech additions. Namocell Inc. in June 2022 and Lunaphore Technologies in June 2023.
And these two are really the capstone of their instrument strategy. They define the next generation of their toolset. Namocell is all about single-cell analysis technology.
So understanding that not all cells in a tumor are the same.
Right. But it's the acquisition of Lunaphore that's truly groundbreaking. It targets spatial biology.
Spatial biology, that seems to be the big buzzword right now. Why is it so important?
Well, if ACD let you see RNA inside a cell, spatial biology takes it to the ultimate level. It lets you analyze thousands of molecular targets, proteins, RNA, DNA, all at the same time, while keeping their exact location in a three-dimensional tissue structure.
That level of detail is just incredible.
It's critical for developing new targeted therapies, especially in cancer and neuroscience. By buying Namocell and Lunaphore, Bio-Techne is making sure they own the instruments for the highest resolution, most cutting-edge biological research platforms available.
It's a remarkable strategy, really. Phase 1, buy the basics. Phase 2, buy stability. Phase 3, buy the instrument platforms to lock in customers. And Phase 4, buy the blueprints for the future.
A perfect summary. And all along, they kept up the global push, like buying Space Import-Export in 2016 specifically to strengthen their European leadership.
What you need if you're going to sell and service all these complex machines worldwide.
Absolutely. The technology is useless if you can't get it installed and supported in those crucial European markets.
Now let's look at the results of this entire decade of M&A. The 2025 financial data, it tells a very clear story.
A story of successful scaling and, just as important, successful integration. The strategy absolutely paid off in terms of size and stability.
So let's break down those key figures from the 2025 report. This is the hard evidence that this whole strategy was viable.
It is. The top line number is impressive. Revenue of US dollar $1.22 billion. Hitting that billion-dollar mark is huge for a specialized company like this. It shows they've captured significant market share.
And their total assets are reported at $2.56 billion.
Right, which comfortably exceeds their liabilities. You see that in the $1.92 billion in total equity. It confirms they're structurally healthy.
Okay, but I have to pause here. Revenue is high at $1.22 billion. But the bottom line figures seem a bit modest in comparison. Operating income was $102 million, and net income was $73.4 million.
That's a great question.
How do you reconcile $1 billion in revenue with a relatively thin net profit margin?
And that is the critical analytic moment. That low net income isn't necessarily a sign of inefficiency. It's the direct financial evidence of the M&A strategy we've been talking about.
So it's the cost of growth.
It's entirely the cost of growth. The difference between a $1.22 billion in revenue and $73.4 million in net income shows us they are heavily reinvesting. They're choosing growth and market position over short-term profit.
So we're talking about massive integration costs, streamlining processes, unifying IT systems, and paying off all the costs associated with dozens of acquisitions.
Precisely. And the R&D burden to take a technology like exosome diagnostics from just a promise to a commercial reality, they were accepting smaller immediate profits to build a much larger, more valuable platform for the future.
The human capital figures also reflect this challenge. 3,100 employees globally in 2025.
I mean, just think about the organizational complexity. Managing 3,100 people across dozens of previously independent, highly scientific firms, you're not just buying patents, you're buying teams, expertise, infrastructure that all has to be standardized.
It requires a really efficient integration process.
A highly efficient and repeatable one.
And just to mention the leadership that oversaw this stabilization phase, the key people in 2025 are Kim Kelderman as CEO, James Hipple as the CFO, and Robert V. Baumgartner as chairman.
And that leadership continuity is so important for steadying the ship after a period of such rapid expansion. You need that stable financial management.
Finally, their market significance is just undeniable now, being traded on Nasdaq and, crucially, being an S&P 500 component.
That confirms it.
It puts them among the largest, most influential public companies in the U.S.
And being in the S&P 500 means institutional investors see them not as some speculative biotech play, but as a core, reliable piece of the modern industrial and pharmaceutical infrastructure. They successfully aggregated value by owning the entire workflow.
From the initial reagent to the final sophisticated instrument.
That's it.
So if we summarize this entire journey, it really is a textbook case study in corporate transformation.
Absolutely.
Going from a small regional player, research and diagnostic systems in 1976, to the multi-billion-dollar, highly focused Bio-Techne of 2025. And this entire monumental pivot was driven by that executive change in 2013 and a relentless decade of M&A.
And the key takeaway for you, the learner, is that the value of a company in this space is often defined not just by its internal R&D, but by its ability to strategically acquire specialized IP and platforms.
Speed was everything.
Paramount. They didn't try to invent the protein-simple automation or the exosome liquid biopsy from scratch. They just bought the innovators.
They focused on creating those comprehensive end-to-end solutions. And by making those massive platform acquisitions, they became a one-stop shop, ensuring that once a customer was in their ecosystem, they stayed there.
And their story shows a powerful reality. In an industry moving as fast as this one, innovation is often achieved through aggressive consolidation. And they manage the immense financial risk of that speed by using cash for stability and those complex earnouts for the frontier tech.
Which leaves us with a final provocative thought. Given Bio-Techne's consistent track record of buying these very specific high-tech firms, gene editing, exosomes, single-cell, spatial tech bracement, we know where the cutting edge is. The question now becomes, what specialized piece of lab or diagnostic technology, maybe an AI-driven image analysis or rapid point-of-care testing, might be the next target for consolidation in this market?
And which small, innovative company might be about to get that $300 million cash offer with a massive earnout tacked on? The consolidation of the space never ends.
Keep watching those emerging tech startups. Bio-Techne and its competitors certainly are. It's all the time we have for this deep dive. Thank you for sharing your sources.
My pleasure.
And we look forward to going deep on the next one.